Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account update and also the market today. Today my account lost $3,569. Today the market rose as US non-farm payrolls in December exceeded expectations and US stocks soared. In addition, Institute for Supply Management ISM Service Industry Index released. So first, let's take a look at my account today. Right now, the net asset of my account is $96,106.89. So today, $5,074.45, and that's due to the decrease of SQQQ that decreased for $2,319.57, and a change of negative 3.29%. DRV decreased for 2,755, a more volatile decrease of 9.96%. Both of the ETF are bear ETF, which means that the market is doing well. Then let's take a look at the market today. Today, Dow Jones rose for more than 2%, as well as Nasdaq and S&P 500. All of the industries showed a significant increase today, especially semiconductors and consumer electronics. At the same time, diagnostics and research decreased for 1.67%. Investors welcomed the closely watched non-farm payrolls on Friday. The report showed that U.S. non-farm payrolls rose by 223,000 in December. The market expects this number to increase by 200,000. The previous value was revised down from an increase of 263,000 to an increase of 256,000. Wage inflation cooled significantly in December, with average hourly earnings rising 0.31% month to month, lower than market expectations of 0.4%, and the previous revised value was 0.4%. The year-on-year increase of 4.6% was also below market expectations of 5%, and the revised value in November was 4.8%. The unemployment rate unexpectedly fell to 3.5%, lower than expected, and the previous reading of 3.7%. Since March, the unemployment rate has been fluctuating in a narrow range of 3.5% and 3.7%. The labor force participation rate unexpectedly rose, rising 62.3% in December, higher than market expectations of 62.2% and 62.1% in previous months. Separate data released on Friday showed that the Institute for Supply Management Services Index fell 49.6 from 56.5 in November, the lowest since May 2020. That figure was lower than the forecast of all economists surveyed. A reading below 50 indicates a shrinking industry. The services index fell nearly 7 points from the previous months, the biggest drop since the early days of the pandemic, likely due to the chaos of holiday travel and widespread power outages caused by a cold winter. Wells Fargo analysts noted that while the labor market is slowing, it is only slowing gradually, and monthly non-farm payrolls growth is still higher than the pre-pandemic average and in line with the pace of hiring. Nick Timiraos, a well-known analyst with the Federal Reserve News Agency, commented on the U.S. quarterly adjusted non-farm payrolls data for December. The revised average hourly earnings data showed that the Fed is slightly less worried about wages than reported in November. The monthly rate of hourly earnings was revised down to 0.4% in November from 0.6%. Separately, hourly earnings growth of 4.6% in December was lowest since August 21st last year. After the release of NFP report, the Fed Watch tool of the Chicago Mercantile Exchange shows that the probability of the Fed raising interest rates by 25 basis points on the range of 4.5% to 4.75% in February was 64.2%, and the probability of rising interest rates by 50 basis points was 35.8%. The probability of a cumulative 25 basis point hike by March is 11.1%. The probability of a cumulative 50 basis point hike is 59.3%, and the probability of a cumulative 75 basis point hike is 29.6%. Market participants are widely concerned that the Fed's insistence on aggressive rate hikes will tip the U.S. economy into recession. Leon Cooperman, an analyst at Omega Family Office, said, "I think there will be a recession in the United States by the end of this year. Due to the Fed's insistence on raising interest rates, quantitative tightening, a stronger dollar, or oil prices." He believes that before the recession occurs, the U.S. stock will fall by 35% from their peak, as the S&P 500 will fall to about 3,000 points. JP Morgan's report also noted that most of U.S. businesses expect a recession in 2023. Nearly two-thirds of U.S. small and medium-sized businesses expect the country's economy to fall into recession, noting that rising operating cost prices have become top concern for businesses in the country after months of the Federal Reserve's ongoing battle with inflation. More than 90% of mid-sized business leaders say their businesses are facing challenges from high inflation, and 45% of small businesses ranking rising costs as their top concern, up 20% from last year. This week, OECD forecasts that both US and the Eurozone will grow by just 0.5% by 2023, well below historical averages, and Germany, Europe's largest economy, will actually contrast by 0.3%. The Bank of England expects the UK economy to continue to shrink until mid-2024. An International Monetary and IMF Managing Director Georgieva said over the weekend that main engines of global economic growth are slowing at the same time, making global economy in 2023 more difficult than 2021-2022. Thank you for listening. That's all I have for today. Don't forget to subscribe and like. See you next episode.